We've been talking a little bit about this from the perspective of investors and entrepreneurs, people who directly kind of are affected by these valuations. But one reason that people in Congress, that people outside of the markets think about the IPO market and the capital markets is because it's related to job creation, hiring. As Steve mentioned at the beginning, the Jobs Act was meant to make it easier to go public or stay private in some cases, because there have been some economists have suggested there's a link between those two things. So, Howard, when do you feel like you've hired more people, and outside of the compliance department, we know that's probably grown, but do you feel like going public was critical to you guys just growing and adding more people, or do you think that public is a step that's not necessarily related to that?
Yeah, so I think as a high growth company, you are hiring people kind of either way, whether you're private or public. And I reflect back on whether kind of the IPO made us hire more people. I'm not sure it did. I think the effect it's had on us is actually the quality of the people that we hire is better. Particularly here in New York. Yeah, I think in other parts of the country, people just want to join startups, take tons of risk. But in most people really kind of enjoy the security blanket of being kind of with a public company, and certainly very competitive. Particularly for a company like OnDeck, we're competing with all the investment banks. So being a public company has really helped us attract a better, higher quality applicant. And to be frank, our applicant pool has never been as high quality as what we've seen today. So I think that's where the difference is.
And David, you at CommonBond, you guys have a strong sort of social mission as a part of your business. You've really kind of tried to build that into that. Do you feel like you can achieve that as a private company versus as a public company, where you have a more diverse shareholder base? One thing people have talked about is, if companies stay private, the benefits of those companies aren't shared as widely, especially among, it's a narrower pool of investors. So how do those two things match up, being public and private and social mission?
Yeah, it's a good question. By the way, we have a pretty strong one-for-one social mission. We're the first in finance and still only actually to have a model like this. We call it our social promise. So for every degree fully funded on our platform, we fund the education of a student in need for a full year. And we've partnered up with Pencils of Promise, which is an education nonprofit based here in New York, in order to fulfill that. In fact, I just got back a couple weeks ago from Ghana, where Pencils of Promise has a string of 54 schools. And at these schools, we help fund students to go to those schools. So we were able to see our impact firsthand. Having a strong social impact with our business was something that was very important to us from the very moment we started it. We are a group of millennial founders who believe that business can and should be a positive force for change. We've been inspired by companies like Warby Parker and Tom Shoes. And when it was time to start a company ourselves, we decided to put our money where our mouth was. So by the end of 2015, we will have donated about $200,000 in total in just 2 years of being at national scale to our social mission. That number, if you look at our projections, will surpass $1 million within about 2 years. It's not something we have to do. It's something that we want to do. We think it's the right thing. And by the way, it happens to be good for business, is a nice positive externality. And specifically what I mean by that is, if I think about some of our great employees, over half of them heard about us because of our social promise, and many of them ultimately accepted our offer because of our social promise. If I think about our borrower base, which actually is the millennial generation, many of them actually become aware of our product and company because of our social mission. And once they become borrowers, it's that social mission that makes being a common borrower something bigger than your own self, that actually fuels a lot of advocacy that we see among our borrower set. And that bleeds into the business. Word of mouth referral marketing is the largest driver of acquisition in our company. That's free marketing. That keeps our cost of acquisition low. That creates for strong unit economics on a going forward basis. And when I talked to other founders like Neil Blumenthal over at Warby Parker, and I asked him the exact same question when we were starting CommonBond, we both share a Wharton connection. And I asked him the same, what happens when you want to go public and you got to maximize shareholder value? And he said, and I fully believe this and share this now, if investors don't want to invest in us because of our social mission, they don't have to, but that's who we are. And if employees don't want to work here because of our social mission, that's okay. And same with customers. But what we found is we found some pretty incredible investors along the way that include individuals, Vikram Panda, who used to run Citi, Tom Gloser, who used to run Thomson Reuters, as well as August Capital out in Silicon Valley, Tribeca Venture Partners here in New York, as well as Hans Morris, who used to run Visa, currently sits on the board of Lending Club over at NICA Partners. So I think having a social mission can actually be mutually reinforcing to the for-profit motive and doesn't have to be mutually exclusive.
And so being a private company doesn't inhibit that in any way.
So I would argue that, and I would hope and I would encourage academia to do more study here, that companies with a strong social mission, with strong values that treat customers well, that treat the broader community well, whether it's at home or abroad, would actually build more value in their enterprise long term than those who don't.
So why don't we've got a couple of questions here from the audience. We had a few people ask for Howard of OnDeck, was going public worth it? And if so, what was the best thing that changed about your company doing so?
Yeah, it was certainly worth it. I think for the reasons I cited earlier, we have a very long-term view of the business. We think over the long term, it makes a lot of sense for OnDeck to be a public company. We're very glad with kind of our position as it relates to our competition today. The best part, there's a lot of memories created during the process to go public, but I think the end result, we have a lot more discipline from a decision-making perspective, from a strategy perspective, from a financial performance perspective, as a public company than we did a year or 2 years ago before we went public. And I think the rigor of the public markets really, force that upon you. So I think our company is stronger today as a result, and that's probably the biggest thing that I take away.
Here's a question for Sean. You wanted investment banking questions as before. Somebody asked whether banks are really competing in terms of underwriting fees. So people talk about the cost of going public. Are banks trying to make it cheaper by charging less for an IPO?
Absolutely. I think we've seen compression in certain circumstances in underwriting fees, and that goes without saying. I think the banking industry is, I wouldn't say crowded, but I would say there's a lot of competition, and one way to differentiate yourself in any industry is based on price. So I think this topic got a lot of press around the time of the Facebook IPO, when people were talking about what gross spreads were and how they were compressing and how it changes based on the size of the offering. We've definitely seen some compression and some competition on that side. That said, at some point in time, you do need an investment bank to help facilitate the underwriting, and there is a fee for it. So the range of those fees is pretty well precedented, and again, it comes back to the size of your offering and the scope of what you're trying to accomplish.
Howard Morgan, somebody raised the question of some of my colleagues at the Wall Street Journal recently have been writing about a company called Theranos, which was a very highly valued biotechnology company that the articles raised some questions about their technology, and many other people have commented, will this have an effect on fundraising for other medical technology or biotechnology companies? And so maybe Theranos specifically, or maybe just in general, are unicorns as a class, kind of under the microscope nowadays, that they're worth so much? And do you think that issues that they have, whether it be Theranos or maybe if Uber has some political issue in New York or somewhere, does that affect valuations and make being private suddenly seem less exciting?
It's certainly true that when you get to the unicorn stage, and certainly the sort of the mega unicorn stage like Theranos or an Uber, you're under a lot of scrutiny from a lot of people. And whatever the merits of the charges on the Theranos thing is, I don't know, it does affect valuations. You see it affecting things. You know, every time there's turmoil with Uber, when they burn cars in France and so on, there are some investors who are scared away. And if there are investors who are scared away, then that's going to change the mix of valuation. Fortunately, in Uber's case, they've been able to get through that. Whether or how well Theranos gets through that, we'll see over the next few months. But unicorns are under more scrutiny, but still without providing really anything like the transparency that being a public company makes you provide. And I've been on 25 public boards over my career, so and watched what's happened after Sarbanes-Oxley when I sort of cut the number of boards way down. But the amount of data, the amount of scrutiny, and the amount of scrutiny in the underwriting process is of real value to public investors, because the underwriters council, and the exchanges really make sure that a lot of sins which sometimes occur in private companies get aired early before the public process. And I think the Jobs Act has helped by having the private filing periods and so on. So you can clean that stuff up and make it right before you get to the public markets. But it does certainly affect the private valuations.